All right, what's up? Welcome everybody. Welcome to another video. In this video, I'm going to talk about market inefficiencies and how to take advantage of them to give yourself an edge when trading any type of market, right? So what I have up here on the screen is a summary of this guy named Nico Tosa, and he ran a roulette strategy that allowed him to profit based off inefficiencies, different imperfections and inefficiencies. So he gained an edge to be able to profit large sums of money based off using inefficiencies. Pretty interesting story. I think it's worth the read, but you can apply this into the markets, right? So basically, all he did was he identified how roulette was played, but he also identified imperfections in, say, the roulette wheel itself, how it was tilted, right? Depending on the tilt and the degree of the tilt can really affect the outcome of where the ball may land. That just defects, wear and tear, right? How the dealer spun the ball, where the ball was right before where he needed to place his bets. And what he did was he waited until the last possible, I believe, like 10 to 15 seconds before the ball landed. He would place his bets, like mere seconds, probably not even 10 seconds, but he would place his bets on 15 numbers. That's what it was, 15 numbers mere seconds before he could no longer bet, where the dealer's like, okay, no more bets, right? And that's the reason why today, where they tell you, okay, no more bets as the ball is still spinning, because of this story, right? Because of this way to exploit the roulette game and your just ability to be able to guess where to land increases the closer the ball gets to where it's about to drop, right? So he would place bets on 15 numbers in an area based on where the ball was, based on the imperfections of the wheel, based on how old the wheel, based on how it was tilted, and where the ball was at the time he needed to place his bets. So he would compute this in his head and place his bets. So he won tons of money doing this, right? And I think even like they try to bust him for it. They arrested him, try to see if like he had like some sort of way he was cheating, which he wasn't, right? Technically he wasn't cheating. He was just computing in his head and using the game's rules to place his bets, right? So, how does this tie into the markets? Well, in the markets, you always hear about getting an edge in the market, right? And what does that mean? What does it even mean to have an edge in the market? Well, it means that you have some sort of strategy or even some sort of minor imperfection, some inefficiency you have identified within the market that gives you an edge, right? That allows you to take an asymmetrical bet in the market to profit off of it, right? So how does this tie into yield farming? Well, from what I've seen in the markets, especially like in the stock market, right? You have the stock market, for instance. Today, it's very efficient. It's a very efficient machine. Spreads are super tight, tons of liquidity. So there's not very many opportunities to game the market, right? To gain an edge over the market, right? Like it's very difficult to profit on a regular basis with an edge, right? Like to really exploit the traditional stock, the US stock market, right? Because it's just the most efficient capital or just liquidity intensive, like it's just everything is just working against you in that case, right? There are still an edge to be had in the markets, right? In the stock market, but it's very far and few between. Usually the ones that are really valid are not normally communicated to everybody, right? Because then you just dilute the edge and then eventually it just goes away. The edge just disappears, right? If everyone's using the edge, it no longer becomes the edge, right? And that becomes the new norm. So then they have to find a new edge, right? That's why people that actually have a profitable strategy that exploits or takes advantage of inefficiencies in markets don't normally sell them, right? or to talk about it, right? But if you go back to like say the 80s, the 1980s, the 1990s, when the stock market wasn't as liquid, when spreads were super wide, where as a broker that was facilitating trades, you could earn tons of commissions doing that, right? And brokers just made a shit ton of money during that time because they were able to facilitate the trades and they would make money on the wide spreads, right? Between the bid and ask. Why were the spreads so wide then? Well, because there was a lack of liquidity. There wasn't a lot of liquidity at the time compared to today, right? There's a ton of liquidity today, and that liquidity just fills in the spreads to where they are today, right? To where they're very tight, one penny wide, like that's how efficient this market is now. So it's very hard for a broker, right? Like now brokerages charge zero commission, right? Whereas just 10 years ago, easily for each trade, you would just pay $10 a trade, right? That's no longer the case. They can't compete with that because now there's brokerages offering zero commission trades, right? So as you can see, as the market evolves and gets more efficient and as more liquidity comes in, brokers have to get more competitive with their offerings, right? They just have to get more creative in how they earn money, right? It's not as easy nowadays. Now take that over to crypto and the DeFi space, specifically DeFi, right? Like say Uniswap, concentrated liquidity, which is what I primarily do nowadays because I see that opportunity, that edge in the market that you can take advantage of. See, today the crypto market isn't as liquid or isn't liquid enough, so to speak, and isn't as liquid as, say, the stock market. There's not a lot of liquidity in there. Spreads are wide, right? Like if you look at, say, Bitcoin, you can see the bid and ask spread right here. It's like $3 to $4 wide, right? On that asset, $3 to $4 in that spread, right? There's that spread there. There's just a gap, like an air gap of just no liquidity between those prices, between the buyers and sellers, right? There's just no liquidity there, right? That just shows there's an opportunity within that. And what's that opportunity? Well, just like I mentioned earlier, the 1980s, you had brokers, tons of money on the spread by facilitating a trade, right? So you look at Ethereum, right? It's probably the most liquid asset in DeFi, right? But it's not where it needs to be fully efficient, right? So there's opportunity there. There's that spread. There's an opportunity because DeFi is not regulated yet, right? There are some institutions that use it, but not all the institutions that are bound by regulation. They're not in this space yet, right? They're waiting to get into the space and dump trillions of dollars into the space, right? And flood the market with liquidity and then dilute the yields, right? Spreads get tighter, there's more liquidity, yields dilute because there's essentially more mouths to feed, right? The way concentrated liquidity works, you stake your liquidity. As people use your liquidity to trade, they pay you a fee. As some of you who have been in the concentrated liquidity space for some time, Ethereum USDC a couple years ago, the 0.3% fee tier was the one that you had to stake in, right? And it was very profitable as far as earning yields. You would earn a ton of yield on there. Today, in 2024, right now it's June 2024, 0.3% pool is not really the ideal fee tier to be in. And why is that? That's because liquidity has been pouring into the space. And that shows me that there's interest in the space, which is great for adoption in crypto. Not so great for yield farmers like myself, because eventually there comes a tipping point to where you have to decide, okay, should I continue to stick and stake into the 0.3% fee tier? Well, as liquidity providers start weighing that option, they're like, well, maybe I could jump over to the 0.05% fee tier pool, which is a much smaller fee, right, that we earn as liquidity providers in exchange for you get a larger share of the yield in that fee tier pool. And what you're doing is you're lowering the fee you charge traders to interact with your liquidity pool, right? So a Uniswap for traders, if they see that there's liquidity in a lower fee tier pool, the smart contracts would automatically direct their trades to the lower fee tier pool until all the liquidity is used up at that price, at that tick, right? At that price. And then it would jump to the higher fee tier price, right? And use up that liquidity. Now, that's very important to understand because, traders want to pay as low price as possible. They don't want to pay anything, right? But liquidity providers want to earn on every trade. There's an opportunity for business there. And we're negotiating business, right? Eventually, there becomes too much liquidity in, say, one fee tier, like the 0.3% fee tier, that liquidity providers are like, well, I mean, yeah, I'm earning some fees, but not as much as I was, right? But what if I jump over to a lower fee tier pool? That way I could be a larger portion of that liquidity pool, right? While others are still in the other fee tier pool, and I could earn maybe as much or even more than liquidity providers are earning in a higher fee tier pool, right? And that's all determined by volume. Volume can actually outpace and you can earn more in a lower fee tier pool simply by sheer volume, right? So that is the conundrum there and what liquidity providers constantly have to analyze and see, right? Well, today I'm starting to see the 0.01% fee tier pool gaining traction. It's not really good for liquidity providers because now yields are going to they're slowly getting diluted, right? They're getting lower and lower and lower, but it's good for the space. There's adoption and there's opportunity there, right? But it's very important to understand these opportunities and these inefficiencies in the market due to lack of liquidity, due to the spreads. That's why you got to take advantage of these opportunities and give yourself that edge, right, in the market, right? Especially if you're one that is holding crypto, like say you're holding Ethereum, why not just earn some yield on top of that, earn some trading fees, take advantage of that edge of inefficiency in markets to earn that yield, earn extra on top of what you're hodling. So it's very interesting. And it's really just going back to just like the Nikotosa story, right? Of playing roulette and understanding that following the rules in the markets, that's usually for the sheep, right? And it's usually a way to herd the sheep to have these rules in place, right? To show people this is how you invest and this is what you do, right? But if you keep your eyes open and search for those opportunities, those imperfections in the market that not everybody is seeing, you can take advantage of it. It may be for a short time, it could last a long time, who knows? But as a market participant, it's very important for you as an individual to be able to keep your eyes open for these opportunities. It's your job. In fact, it is your job as a market participant because what you're doing is you're finding these inefficiencies. And as more people find them and identify them, they realize like, holy crap, there is an inefficiency here, right? But slowly that edge gets diluted as more people dump liquidity into it and try to take advantage. And eventually the market will close up that opportunity, but then it'll become more efficient, more liquid as a result, right? And it would create a better market. That's the goal, right? So you might look at it thinking, well, if it's inefficient, maybe it's just bad or maybe it's evil, right? Well, it's not. What you're doing is you're identifying some imperfections and inefficiencies and drawing attention to them, not necessarily by telling people, but by just being in there and other people that have their eyes open can identify it early and also take advantage. So it's very important to keep your eyes open And just think back to the story and read this story of Nico Tosa and how he exploited roulette, right? And it's really interesting. And you could apply that same type of concept to the markets. So that's my market lesson for today. Hopefully it helps and just kind of give you a different thought process in how to think about the markets. All right. Have a good day.